Well, greetings everybody. So what you see here is a problem from our assignment on MyMathLab. And I'd like to show you a way to do it that's a little bit different than if you had tried to use these help features. So when you see the problem in MyMathLab, you can, if you want to, use help features to learn how to solve a problem. Help features such as help me solve this or view an example. And if you do that, it's going to be a little bit different than what I show you. Okay? So I'll just let you consider how I'm going to show you now versus the help features if you want to, and then you can pick between those and try to learn it and solve it that way. It doesn't really matter to me. The reason why I'm showing you a way that's a little bit different than what I think you'll see in the help features is this problem is about calculating expected value. And I've made videos for some other problems in the assignments about expected value, such as in a roulette game, a lottery game. Okay, and I wanted to do this problem about a life insurance policy in a way that's similar to those other problems, where these help features I think you'll find seem different than other problems that I've showed you about expected value. Okay, so with that disclaimer, I'm going to go ahead and show you how I would solve this problem. So I'll let you read the problem, but here's the breakdown as far as I see it. There are two scenarios for this insurance provider. One is that the person who's insured lives through the year, and it's almost certain that's going to happen. More than a 99% chance. That's the probability that this person who is insured lives through the year. Now, when a person buys insurance, they have to pay the insurance company to be covered, and we're going to say that that's P. So with a more than 99% chance, the insurance company receives a payment of P from the person being insured. Okay? The other scenario is that the person does not live through the year. So what are the odds that that happens? Well, the person either lives through the year or doesn't, and the odds that they don't live through the year are 1 minus the probability that they do live through the year. And that's almost 0%, 0.00032. Okay, that's almost unheard of that that's going to happen. Very close to 0% chance. Okay, now what does the insurance policy or the insurance provider receive in that case? Okay, well, if the person does not live through the year, they receive their premium, their payment for being insured, P, but then they lose this death benefit, this payout of $900,000. Okay, so they receive the payment from the insured, but they have to pay back out $900,000. That's why what the insurance company has in that case is negative $900,000 plus P, or you could say, if you wanted to, P minus $900,000. So expected value will involve these things. There will be scenarios. There will be a probability that each scenario happens, and then there will be a payout in each case. So I got the probability the person lives, the insurance company receives P, and they don't live, the insurance company receives P minus 900,000. Okay? All right. Now, in this problem, the setup is that we want the insurance payment or the premium, what the insured person pays to be insured, P, we want that to be such that the expected value is 500. Okay, so that means like a long-term average over insuring lots of people. Sure, you might occasionally pay out this huge death benefit, but you'll receive some premium so that the long-term average you're going to get is $500 per person. Okay, all right, so let's figure out how to set this up, figure out what P needs to be so that long-term average is $500. Okay, all right, so here we go. Here's how we set up an expected value. Now again, I showed you those other problems from Canvas or other problems on the assignment, expected value in a lottery game or a roulette game or something like that. The way that we solve or set up for an expected value is we take the probability of the event happening times the payment received plus the probability of the other event happening plus the payout times the payout received, and then that's the expected value. In this case, here's the probability the person lives through the year. P is the payment the insurance company receives in that case. Then here's the probability that they don't live through the year. And then here's the payment that the insurance company receives in that case. And we want that to be 500. Okay? So there's our expected value formula. That's the same formula that I would have used to show you other problems about expected value in the assignment. Now, when we solve this, the goal is to solve for P. The goal is to find out how much should the person pay to be insured. Then I can multiply through both numbers in this parentheses by 0.00032. If I do that, I'll get 288, 0.00032p. Okay, I'll move this 288 over there with the 500. It'll look like that. These two will always add to 1 in this type of problem. And there you get $788. So you should charge a person $788 to be insured. And then your long-term earnings will be $500 per person in that case. Okay? All right. And that's, of course, the answer that you see there. The company should charge $788 per person. Now, if you've never solved an equation like this, don't worry, you don't have to figure out how to solve it from scratch. When you set your problem up that you find in the assignment like this with different numbers, then, all right, you'll have different numbers, but they'll be in these same spots. And so you can solve it just like I have here. Okay? All right, now there's our answer. That's how we solve it. I've given you an answer and so on. That's everything we need to do. But still, I want to make sure that we understand the relevance of that number. Like if I say, well, I want the expected value to be 500, and in order for that to happen, the person has to pay 788 to be insured. What does that mean? Well, one way I could say it is that, sure, sometimes the person just pays you and the insurance company receives that. Sometimes you got to pay out this massive death benefit. It's not very likely. It doesn't happen very often, but it does happen. But the long-term average between those two things happening, this one most of the time and this one very rarely, is that you'll get about $500 per person being insured, over insuring lots of people. Now, I thought like I could end the problem there. You know how to solve it. I've told you a little bit about what the answer means. And if you're happy with that, fine. But I thought it'd be good to compare with maybe something a little simpler so you can see it more tangibly. The problem over there is kind of like this. Suppose I want a bet on whether it rains or not tomorrow. Suppose it rains with probability 1 out of 5, and I win $10 if it rains. If it doesn't rain, well, the odds of that happening are 4 out of 5, and I'll lose $2. Okay, so it's kind of like that over there. There's two things that could happen. There's a win or a loss. There's amount of money that I either receive or pay. Okay, and then there's a probability of each event. Okay, all right, I can calculate the expected value like this. The probability of it raining times I win $10 plus the probability of it not raining times I lose $2. If I multiply these and add them together, I get 0.4. All right, what's the 0.4 mean? It's kind of like over here. What's the 500 mean? Well, I'm saying over many bets, if I play this game many, many times, I'll expect a total average return of 40 cents. Okay, so I'll win, if I play this over and over and over, 40 cents per bet will be my average return over many bets. So in order to try to see how it actually happens, let's do this. Let's assume that these probabilities really hold to be true. So like 1 out of 5 days, it'll rain, and 4 out of 5 days, it won't. And I'll assume my wins and losses, okay? So let's see if we can actually see that, yeah, you'll get an average return of 40 cents per bet. So, okay, let's say we do 5 bets. One of those days, it rains, and I win $10. And then 4 of those days, I lose $2, okay? So my total winnings will be, well, I'll win the $10, but then I'll lose $2 4 times. So I'll win 10, but I'll lose 8. So my total win will be $2. So how's the expected value of 40 cents? Well, it's a per bet average. So I won $2, but that was over 5 bets. And if you do 2 divided by 5, you get 40 cents per bet. Okay. So that's how we can understand that expected value. If I play this game betting on if it's going to rain or not tomorrow many, many times, I'll win sometimes, I'll lose sometimes. But if I add it all together, then I'll get, in the long run, on average, 40 cents per bet. So I'll come out ahead if I keep playing. All right. Uh, all right. So that's kind of like this number here, 500. The person, I'll charge them $788 for the insurance policy. Occasionally, I'll pay out $900,000. But, in the long run, I'll get an average of $500 back from each person that is insured in this case.